Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
It's been another volatile day for stock markets around the world after yesterday's big falls in America. The global sell-off was sparked by concerns that interest rates may rise in the US more quickly than expected, pushing up borrowing costs for companies and consumers. Our economics editor Kamal Ahmed reports.
The opening bell in New York today. Optimistic as ever. It is America. But on trading floors around the world, Frankfurt, Tokyo, London, worry as stock markets suffered their third day of falls. After the calm, the record highs, this is the correction.
We still see this as a correction and not as a profound change in the fundamentals that would mean that potentially we're entering a more difficult environment. But nevertheless, we have to understand that we are at a juncture in the global economy and in markets that might imply that the way forward is a lot more difficult and trickier than it was.
The dramatic falls follow a remarkable upward run. The major American market, the Dow, and in the UK, the FTSE 100, have been rising for a decade before the sell-off began. Over the last 3 days, the Dow has fallen by 7.1%, and the FTSE 100 has fallen by 4.7%. This has been an era of money printing. Central banks that have kept interest rates at record lows and pumped in trillions of pounds of economic stimulus. The fear in the markets now is that inflation is returning because of strong global growth, interest rates will rise and the stimulus taps will be turned off.
Events in the city, events on Wall Street can seem a long way away from the high street, but the health of the stock markets does matter. It matters, of course, if you own shares. It matters if you have a pension fund, often invested in stock markets. It matters if you have savings, often invested in stock markets. When stock markets go down, the negative effects can be felt by many millions of people.
America led the rise and has been leading the dip. And that's a bit tricky for this man.
The stock market has smashed one record after another. We've hit, I guess, close to 60 records. Our stock market has reached an all-time high today.
Will the president have to eat a little humble pie?
Let's refocus. Let's look long term. And while it's difficult to do in these situations, in these times, keep a diversified portfolio. It's can't have all your eggs in one basket.
This is not yet a market crisis. The economic fundamentals are strong, particularly in Trump's America. Not many believe a full crash is imminent, but sentiment, emotion drives markets as much as facts, and sentiment is hard to predict. Kamal Ahmed, BBC News.
Now, the turmoil on worldwide stock markets has continued into a second day, with the FTSE suffering its biggest one-day fall since the result of the Brexit vote. It was fuelled by overnight slumps on markets in Asia and rocky trading on the US Dow Jones. Well, our business editor Joel Hills is here. So go on then, tell us, what's behind this and how worried should we be?
Well, not worried. This looks like a correction rather than a crash. Put another way, Mary, you've seen a period over which share prices have risen and risen and risen over an extended period. That great run has come to an end in quite spectacular fashion. Exuberance has turned to high anxiety, and the scale of the sell-off, let's be clear about this, was spectacular. In London this morning, the FTSE 100, the measure of the value of the 100 largest listed companies in London, sank like a stone. It did rally slightly in the afternoon, but closed at 7,141. That is a terrible day's trading. But the last time the index was like this, context is important, was last April. As you can see, it's been on the rise pretty much ever since. Stock market trouble, Mary, doesn't mean trouble in the real economy. In fact, interestingly, the global economic outlook's pretty good. There's something of an upswing going on, and it's that has upset investors. They are worried that the response to all the economic data, the good news, largely in the United States in particular, is that central banks will start raising interest rates. Remember, they're still at very, very unprecedented low emergency levels. The Bank of England has started the process of raising them again, but the markets are worried that the good times are over, the era of cheap money coming to an end.
All right, Jill, fascinating stuff. Thank you.
What goes up must indeed come down. And there's been another tumultuous day on markets around the world, with frantic trading following 2 days of heavy losses. On Wall Street, prices briefly rebounded before taking another tumble, while here in London, the FTSE ended the day almost 200 points lower. It's all been fueled by concern over the prospect of higher interest rates and rising inflation. But is all this just a correction or a more serious crash? Here's our economics correspondent, Helia Ibrahimi.
Last night, US stock markets lost $1.3 trillion in the biggest one-day fall in 6 years. In Asia, it was a sea of red, with $503 billion wiped from the Chinese and Japanese stock markets. And in Britain, the FTSE 100 woke up to a $99 billion loss. While markets have recovered a fair bit already, the speed of the sell-off yesterday has left trading floors like this one reeling. And the question is this the first slide in a big bear market? And for consumers, perhaps the start of a recession? Or is this just a market tantrum that's all about interest rates going up? President Trump has talked up the market rally since his election, but in an uncomfortable moment yesterday, even Fox News had to cut away from a speech to report on the shock market collapse.
We're interrupting for breaking news. There is quite a drop happening on Wall Street. A massive sell-off is happening today.
Corrections don't come in a very smooth and gradual way, but speed and the scale do matter. If you look at the performance of the first 4 or 5 weeks this year, it was extraordinary.
Unsustainable?
So, I would say at that pace it was, and people were waiting for some kind of an adjustment. Markets can be fickle, markets can be volatile. As you say, what goes up can come down.
It's hard to believe for those who haven't seen a pay rise in a decade. But since the financial crisis, stock markets have generally been a one-way bet, a 9-year-long rally. But that mood of complacency has now had a rude awakening. The roller coaster ride of the last 24 hours has been extreme, but look at it in the longer context. Since Donald Trump was elected, the Dow Jones has soared 39%. In the UK, the FTSE has been close to 7,000 in the dot-com bubble, during the heady heights of the credit bubble, and hit an all-time high of 7,778 less than a month ago. And what a first day for this guy, the new head of the Federal Reserve, who holds the key to the mood of panic in the markets. Will the Fed hike rates faster than expected, as yesterday feared? Or will they now be handcuffed by a new market vulnerability? Is the problem here that markets have become addicted to free money and the tap's about to turn off?
Markets adapt to an environment, and the environment that we had seen in recent years was one where central banks have been extremely accommodative for good reasons. Now they have to adjust to this new environment. So whether it's addiction or not, I think it's basically becoming used to and learning that we are moving into a more normal world again.
So far, this doesn't look like a repeat of the 2008 crisis that devastated the banking system and kicked off a global recession. But those that say it's just a reset of a booming market know that the risk of a reckoning is never far away.
So how will all this actually affect us, our pensions, our savings, our mortgages? Well, Helia's with me here. Helia, how will it affect us?
Well, listen, the wild swings that we've seen even today in the US market, I mean, it opened, went down, it recovered a bit, then it's gone down again, is matched by this both feeling of panic in the market and buying. You know, I spoke to the fund manager, Chris Benodi, earlier this morning, and he was talking about all of us, the global market, sitting on a powder keg that was about to explode. And the fear here is driven by the fact that here you've got a Federal Reserve that might increase interest rates faster than the market expected. Mm-hmm. And since the global financial crisis, we've basically been at emergency monetary policy. So that's easy money. That's good times for the markets. That could all be coming to an end, and the market doesn't like that. The question is, what can central banks now do 7, 8 years later?
So people are talking about the end of cheap money. What about in this country? What about interest rates here? Is Mark Carney going to do something dramatic?
Well, on Thursday, you have an interest rate decision, and economists have been expecting, you know, the Bank of England to hike rates in this country maybe 3 times this year. And that, of course, has an effect on consumers. It's unclear whether if we see this turmoil continue to expand, whether that will make people at the Bank of England and Mark Carney think twice.
Helia, thanks very much indeed. Well, all this started, of course, with a sharp drop on the New York Stock Exchange, which has been fluctuating wildly so far today. Well, our chief correspondent, Alex Thompson, is on the trading floor. Alex, what can you tell us?
Certainly am, Matt. Well, it's lumpy, it's bumpy, it's stormy again today. Not, I have to say, like yesterday, but the morning after the night before, it really is. Who do you believe? These lurid global headlines about bloodbath, people talking as you did about the possible end of cheap money. The Treasury Secretary here in the US saying it was a reasonable adjustment to a hyperinflated market, although a little large. Maybe a little bit of British understatement about that statement, perhaps. Well, to discuss all of these factors, I'm joined by Alan Valdez. He's got 35 years experience as a senior partner with Silver Bear Capital here in Wall Street. So I guess the first question has to be, in layman's terms, cut through the jargon here, was it a crash, a crisis, or is it don't panic?
Don't panic. You know, coming into yesterday, the market year over year was up at roughly 40%. It was a 4% downward draft yesterday, and that was it. I mean, it was breathtaking to see the market down over 1,000 points at one point, but basically when you look at the percentage, it was just a small, it's not even a correction. Correction's 10%, this was 4%, right. So it wasn't much of a
and it only takes the market back effectively to where it was at a very healthy pitch, what, mid-December?
No question about it, it really does. And then today we saw a lot of volatility. You know, we've been waiting for volatility and it's finally back.
There's a lot of red on the screens right behind us now.
A lot of red, we're down about 100 points, but we've had a 1,000-point swing today. We were up over 300 points, we were down, up, down. So I think we'll see this volatility continue for a while, but overall, no need to panic, especially if you're in it for the long term. Yesterday was like a sale day. It's like my girlfriend going shopping and getting things on sale. And sure enough, a lot of buyers came in, bottom feeders. Today they came in to buy. So overall, there was no panic, and it was all computers, all algo systems.
Let's blame it on the computer.
That's
then.
it.
Treasury Secretary certainly did that, but he's got a political reason to do so. Overall, though, unemployment in this country, 17-year low. The fundamentals of the market undeniably strong. Nobody can disagree with that. But, and there are two buts, there is a potential here, potential for inflation. There's a potential for the Fed, therefore, to come in and start hiking interest rates. There are some clouds on this horizon.
Oh, sure, there really are. And I think one of the reasons we saw this market start to cascade on the downside Thursday and Friday was because of two things that haven't happened yet. And when they do happen, they may be good. And that is wage growth, which is finally ticking up. But with that comes inflation. So those are two things that are good for the general public, but could be bad for the market, the equity market in particular.
And it's not just the fundamentals here, as you would have it. The fundamentals of economies around the world, generally speaking, are pretty rosy, right?
Correct. I mean, it's strong in Europe, it's strong in Asia. So basically, the world's awash in good money. People are working. And I think the future holds great promise. I really do. Today, we were buyers. We came in here as buyers this morning. It's just the right time. You get these days where they come down like this, and like you just mentioned, all the fundamentals are strong, whether it's unemployment, whether it's wages, they're all going up, so it's a good sign.
So here we are talking optimism in front of a bank of red screens, but I think we've explained perhaps why. Finally, does the president have anything to do with it? Donald Trump, even in January alone, more than 25 times took credit for the buoyant economy. Kind of silent now. Does he really have any influence? Does any president?
You know, they have, if they do, it's just on a day basis. It's no long term, no matter what they say. It's more with earnings. Corporate earnings are what drives these markets. So the earnings have been strong. Top line, 80% of beat on the top line this quarter, 76% on the bottom line. So earnings have been very strong. And that's really the core of the stock market, of what are the corporations doing. Now, he does get credit for the tax breaks, and that definitely helps. You put more money in the consumer pocket, the multinationals can bring money back. It's not expensive to keep it now in the United States, so that helps. And what helps with that, especially with the tax breaks, with the corporations, they buy back. So yesterday we saw a lot of corporations buying back their stock at cheap prices. So if the corporates are buying, we're buying too.
Right, I better let you get some of these red screens green. Thanks very much, Alan Valdez.
Thank you, Alex.
And with that, back to you in London.
Thanks, Alex. Love those bottom feeders.
The FTSE was down 2.5% today. That's partly a crash and certainly nothing to compare to recent fluctuations in the price of Bitcoin. But it still wipes 50 billion off its value. And it came as turmoil in the US sent markets seesawing too over there, finally closing an hour and a half ago around 2% up on yesterday's fall. Although the day ended positively, more positively than it began at least, there's no doubt that this has been a wobbly few days. So how worried should you be? Well, the basic explanation of the volatility is interest rates. Rates potentially going up faster than expected makes profits harder to earn and shares relatively less attractive. And the good news spin is that higher rates are the result of growth, so these are problems of success, which is all reassuring. But there is a bigger way of looking at this, that this is a turning point. We had a crash 10 years ago, we still haven't got back to normal, and this kind of disruption is just a starter as to what to expect as we now do. The banking crisis of 10 years ago that spread across the West was like an economic heart attack. It left scars that run deep to this day. It left banks slow to lend, so companies couldn't get credit to pay for new investment. And too many households were stranded with big debts, so couldn't afford to spend. Across the West, growth inevitably slowed.
For the time being at least, the nice decade is behind us. The credit cycle has turned.
Central banks had to step up to stop economies falling down even further. They printed money and slashed interest rates to near zero. In normal times, with everything under control and inflation low, you might expect the main interest rates to be about 5%. That's the historic average in the UK. But for the best part of a decade, the West has got used to rates at or below 1%. Time after time, people prematurely predicted that growth would return and rates would rise.
It would not seem unreasonable to me to expect that once monetary policy normalization begins, interest rates would proceed slowly and rise to a level in the medium term that's perhaps about half as high as historic averages.
In fact, for years recovery was slow. Economies were lackluster, so rates stayed low. Now though, solid growth really does look to have returned, so the looming question is, how do we get back to normal? Everybody's become used to easy money. The US Fed has started normalising rates, but they're still only at 1.5%. The expected path there is for 3 quarter-point rises a year. But this isn't an exact science. And for investors who are famously vulnerable to overreact to everything, small changes to the expected trajectory of rates can make a whopping great difference to the value of bonds or shares. The path into the era of low rates was unprecedented. The path out of it is uncharted too. Who knows how painful it may turn out to be. So a volatile few days. What should we expect next? And what does all of this in the markets mean for finance ministers, for investors, and of course for the likes of you and I, me and you? Gillian Tett is the managing editor of the Financial Times and joins us from New York. And Pettifer is an economist who for a while was an advisor on financial matters to Jeremy Corbyn's Labour Party. Very good evening to you both. Look, just a sort of opening sentence, how worried should we be? Gillian.
Well, in the short term, moderately uneasy, but not too panic-stricken. In the longer term, we should be concerned because there are some big dislocations in the global economy and we need to address those. And
just expand on that. What are the dislocations you're talking about?
Well, very simply, there is too much debt. There's 40% more debt to GDP in the global system today than there was a decade ago, just before the crash. And the only reason we've not noticed that is because interest rates are super low. So the question today is what will happen when interest rates go up?
Indeed so. Anne, how worried do you think we should be?
Well, I think we should be worried because we've got a new crowd at the Fed. And they want to raise rates, they want to tighten monetary policy. So this represents a very big shift from what we've been through in the last 10 years.
So you sort of buy the argument that this is a transition, a turning point now.
This is a turning point, and I'm not so sure that they will get it right.
Right, but it's very hard to get it right. But you accept that they've got to, at some point, we can't just sit around with interest rates at, well, in the UK at sort of 0.5 point, in the US at 1.5. Is that what you think the new normal is we should sit and accept that?
No,
now
there is
forever?
no. I mean, our problem is that the economic model that came out of the crisis is a deeply flawed model. It was about injecting trillions of dollars into the financial system, into assets, into stock markets, into property, into bond markets and so on, and at the same time imposing austerity. Now, that model has not led to recovery. In fact, I would disagree with you, Evan. We're not really seeing growth. We're seeing a little uptick in wages here and there, but actually we're not even seeing real inflation in the US. So my worry is that we're now shifting into a mode of tightening monetary policy while massive fiscal expansion by the Trump administration.
So this is basically another false alarm in which people are saying rates go up and it's actually not the real recovery that we need.
Well, I mean, there isn't a real recovery, so we have to be very careful.
Wary about raising rates. On that specific point, Gillian, do you believe that the global economy has now turned around? Because certainly most of the world is enjoying, you know, what would be regarded as okay growth.
Yeah, I mean, I'd be a little bit more optimistic than Anne in terms of the fact that there actually is growth going on. But the fundamental problem, and the image I like to use, is that you had a financial system before 2007 that was addicted to cheap private sector debt, heroin if you like. We were weaned off that by becoming addicted to morphine, essentially government help. And what we're seeing is a huge explosion in government borrowing around the world, and that will eventually create problems. What has actually rocked the markets in the last few days in America has been a very funky derivatives project linked to something called VIX, which is complicated. I won't describe the details of it, but it's a bit like the funky products that turned up in the subprime mortgage crisis a decade ago. But that's really just a symbol of some of the excesses that have built up in the system as people have responded to free money from central banks by doing some very weird things to try and seek yields and get returns.
Right.
And that eventually comes back to bite everyone.
And Gillian, would you say, hang on, you can't raise rates now? Or, because in many respects, this is a problem of the methadone or whatever the drug substitute was that we were feeding the market. It's the withdrawal from that that's the problem. But you do want to get people off that, right? I mean, you don't want to just keep it.
I could not agree more. I've been in the camp of people who say that actually we should have started the withdrawal process a bit earlier. And I think that there's going to be inevitable lurches like this as the system starts to go through withdrawal. That's just unfortunately part of the process. But I would argue that the Fed and other central banks do need to press ahead with what has been a pretty rocky ride so far.
But the point is that if we've seen any growth, as Gillian is suggesting, it's been because last year the central banks pumped in $3 trillion. When the economy was meant to be recovering, they had to pump in $3 trillion of liquidity to keep the semi-comatose body alive.
So we can have growth with debt and pumping it up, but we can't have growth without that, and we can't do that forever.
Well, exactly. So the point is there is something very wrong with the model. It's the actual model that is the problem. Economists have not come up with a solution to what to do about the kind of crises that was caused in 2007-9 and what's going to happen next. We don't have an answer. We have a president who's now going to spend money in tax cuts and so on, and he put people onto the board of the Fed who are going to tighten monetary policy, and we know both of those are not going to work. So we just still don't have an answer to the thing that would satisfy the people that have voted for Donald Trump, and they've voted for him because their living standards have just not recovered.
And just a very, very brief one on Trump, Gillian. I mean, how do you think the politics of this plays? Because he tied
How can you be very brief on Trump?
he tied himself to the rises in stock market and said, look, it's all down to me. I mean, does he have to sort of eat a bit of humble pie at least?
Does Trump ever eat humble pie? I mean, no, he's not going to turn around and say, guess what, guys, I was wrong. He was pretty nutty to tie himself to the fate of the stock market in terms of trying to use that as a scorecard for his success. But you know what he's going to do? He'll just distract everyone with something else going forward, and he probably won't talk about it again. And certainly we've already seen today that people are talking about tax cuts, they're talking about deregulation instead, and the fact there is quite a sort of, feel-good sentiment afoot right now in America.
In the real economy. Gillian, Tet and Pettifer, thanks both very much indeed.
Thank you.